All right, we get this question a lot. Should you raise a convertible note or a safe or an equity round for your first financing? This is a pretty complicated question, and the answer is it depends. You need to basically do the math homework. And in fact, if you check the link below, we've created a tool to help you model out this scenario. But reasons why people might want to reconsider using a convertible note or a safe versus an equity round are simply that you may be giving up more to the investors than you would in an equity round. So when people usually say you should do your first round as a convertible note or a safe, they're usually making certain assumptions. Number one assumption that they're making is that your valuation cap is going to be much higher than your valuation in your equity round today. So the argument for convertible notes or safes is usually that you don't know what your valuation is right now. You're going to undergo all kinds of crazy milestones and growth that allow you to get a much higher valuation in your next equity financing round. First of all, if you do a valuation cap in a convertible note or a safe, you're not really avoiding the valuation question. You're essentially setting a valuation. That term in your safe or note is going to be used by any good investor in your next equity round as the basis for the valuation negotiation. So unless you have a really high cap, at which point it's pretty meaningless to an investor, then you are kind of setting your negotiation standpoint in your equity round anyway. So if you have a valuation cap equal to the valuation that you would get in your equity round today, then you shouldn't do your convertible note or safe round, because a convertible note has things like interest and has other features which make it probably more unattractive. So people get a discount, for example, on the price per share in the next round. Number two is that convertible instruments also have what's called a valuation overhang. So when a note or a safe converts into equity in the next round, it generally will get the same kind of stock that the new investor is getting at that theoretically higher valuation. Now, the way the documents are written in your next financing deal is that the investor has what's called a liquidation preference. So they're supposed to get dollar for dollar what they paid to the company as their downside protection. Now, if you have a note or a safe that's converting into that equity at a discount, then that safe or note holder is generally going to get paid the difference between what they paid and what the new investors paid at liquidation. So you've kind of doubly diluted yourself in that sense. Now, that concept is a little bit hard to discuss in the abstract, but you can model it out in an Excel spreadsheet to see the impact. But it's called a valuation overhang. There are ways to deal with it in your next round. For example, you can create a new shadow series of preferred for each type of note or safe that's converting at whatever discount, but then it makes your capital structure gross, and people just don't want to deal with it. It's kind of a pain in the ass from a drafting perspective and from a tracking and stock issuance perspective. It's just not ideal to me. Another reason why you may not want to do a convertible note or a safe round in a particular round is if there's a high change of control premium. So if there's a realistic possibility that you will exit while the note or the safe is outstanding, most investors are going to demand either a 1.5x or 2x change of control premium, so that they would have to be paid back double their investment while it's outstanding, or they might have the choice between that 2x and their valuation cap. If you're going to give that, that's worse off than if you would have just had them as equity holders, where they would have probably a 1x non-participating liquidation preference, meaning that they get their money back or they share pro rata with the common. So you might have doubled the amount of money that you're going to give to an investor with a note if a quick exit or an exit while your note's outstanding is in play. So you have to do the math and the homework on these things and figure out if it's good for you. Lucky for you, we've created a tool. Click on the link down below. Check out our blog post on this matter. Get in touch with someone and educate yourself before you let the people with the taglines tell you what to do on what turns out to be a pretty complicated decision.